Good morning, everyone. I've been at Pearce since 1994, which is quite a long time, and I thought I'd start by having a look at the chancellors that we've had since 1994. Here we are. Ken Clarke, relaxing at Lord's after a small salad and a glass of water for lunch. Then he was followed by Gordon Brown, who appears to be trying to snog Bono. And then Alistair Darling in the guise of international rescue. And finally, our very own George Osborne in an extremely unfortunate photograph. The photographer was obviously being a bit crafty when he took this, given the fact that the M in JP Morgan has disappeared from the screen. I've included the picture of Norman Lamont. He wasn't Chancellor in 1994. He actually was Chancellor until 1993, simply because David Cameron's hair in this picture is absolutely hilarious. It is so coiffed. Did you recognise it was David Cameron? Yeah. Anyway, 1994. How many managers have Blackburn Rovers had since 1994? Does anyone want to hazard a guess? 13. I won't go through the whole list for you because, frankly, we haven't got all day. But the first one was King Kenny Dalglish, right up until to date with Gary Bowyer. I've forgotten his name there. Sticking with the 1994 theme, I just want a quick word about stealth taxes. You hear the expression used, and it's never really quite clear what it means. It simply means certain things not keeping pace with inflation. So although there's no apparent increase in the rate of tax, because certain allowances are eroded away, inevitably more tax is collected. For instance, the higher rate band started in 1994-5 at about 23,700. Today, it's only 31,866. And apparently, if it had kept pace with inflation, commentators do say that it would now be worth about £70,000. So an enormous number of people have been brought into higher rate tax since then. Another example is the termination payment. If someone's office is terminated, they're entitled to compensation. And the compensation can be paid up to £30,000 free of tax. Well, that figure hasn't changed. And it was £30,000 way before 1994. So just imagine how much extra tax that's collected. When you think about the number of recessions we've been through since 1994, how many people will have lost their jobs? And if they've had a payment of more than £30,000, they would have paid tax on the balance. So that's a word about stealth tax. Looking forward, as John mentioned, all governments these days have a habit of pre-announcing things because they want to give you good news, but they don't want to give it to you just yet. It's like, oh God, help me be good, but not until I die. So in 2015-16, the personal allowance is going to go up to 10,500. And David Cameron's been very keen on this. There's going to be a transferable portion of the personal allowance, but only between basic rate taxpayers. So if you have a working couple and one spouse is at home and the other one doesn't earn above the higher rate, they can transfer part of the allowance. It's not going to be worth a great deal, but I think it's political rather than anything. I think it's about £200 a year difference it will make. The basic rate band's been shortened again because every time the personal allowance gets a little bit bigger, the basic rate band gets a bit shorter. So again, more people coming into higher rate tax. And then this 0% savings income band has been introduced. A lot of you probably not aware of the fact that currently, if you have a very low income and part of that income is made up of savings, the first 2,880 of your income is taxed at 10%. So people who have bank interest taxed at 20 will get the 10% back again. Well, this band has been increased to 5,000, and it's a 0% rate on savings income that falls within that band, but only in certain circumstances. It depends on the amount of income that you have and the mix of income. It's actually quite a difficult concept to explain, and I'm very grateful to my colleague Ben Davis, who's produced this diagram for me, because as you can see, it only happens if your savings income is within this small band here. The basic rate, the personal allowance is 10,500 next year, and the savings band is £5,000. So if your savings fall within this small band, you would actually be taxed at 0% on the savings. But if, say in the first example, your salary was £17,000, then you wouldn't get any of the 0% savings band. It's a slight complication to the tax computations, but very welcome for people on low incomes where a lot of their income is actually savings income. And there could be a planning point here. If anybody has a director's loan account that's showing a very substantial credit and they're only drawing a small salary from their business, they could have interest on their loan accounts and potentially not pay any tax at all up to £15,500. ISAs, this is a welcome development. What could be nicer than an ISA? An ISA. An ISA is it's just a new individual savings account. So from July, all existing ISAs will be converted to NISAs. The subscription limit is going to go up to £15,000. And unlike existing ISAs, where you can only invest half of the limit in cash, it can all be in cash. So you potentially could build up quite a decent pot of tax-free income. Sticking with the investment theme, every time there's a budget, there's always speculation about whether the tax relief on pension contributions will be restricted to the basic rate. However, pension contributions are gradually being capped in terms of the amount of relief you can claim. So in the coming year, it's only going to be £40,000 that can be put into a pension. And that's employer and employee contributions, although you can utilise unused premium relief from earlier periods. And the contributions still qualify for higher rate tax relief. So they're still a very useful planning tool. If your income is above £100,000, you will lose some of your personal allowance. And once your income reaches £120,000, you won't be entitled to any personal allowance at all. And you can use pension contributions or gift aid to give you a very good result. So, for example, if someone has income of £120,000, they have no personal allowance at all, and assuming that they don't have any other allowances, the tax liability on that income would be £41,627. But if they were to pay a net contribution to a pension of £16,000, that's equivalent to a gross contribution of £20,000, their tax liability would decrease by £8,000, which is quite substantial, which means that you've got £20,000 into your pension pot at a net cost of £8,000. And just to reconcile that so you can see where the figures come from, because you make pension contributions net of basic rate tax, you're actually paying out £16,000. You get your personal allowance back because the pension's brought your income down below £120,000. The personal allowance is worth £4,000, £10,000 at 40%. You also get higher rate tax relief on your pension premium, so that's another £4,000 back, thank you very much. So your pension contribution of £16,000 has only cost you £8,000. It's because tax in this margin where you're losing your personal allowance is an effective rate of 60%. Tax-free childcare. This was mentioned in last year's budget, and we've now got some more information about it. It's actually a bit of a misnomer because it's really more like a social security benefit than a tax relief. And it starts in the autumn of 2015. Unlike the current scheme for childcare vouchers, the self-employed can also benefit from this tax-free childcare. Basically what it is, it's a special online sort of savings account to pay for childcare. And every time you put £800 in, the Inland Revenue put £200 in. So it's a bit like pension premium relief. The account can also be topped up by other people. So grandparents can make a contribution to the childcare costs, and their contribution is also enhanced by this 20%. And then what the parent does is they can draw money out of the account to pay for childcare costs. The guidance is intriguing because it says all parents must be working. So it's obviously envisaging situations where you've got second marriages and stepchildren and so on and so forth. The fact that everybody involved has to be working does perhaps make it less attractive, and it's yet more discrimination against families where one parent stays at home to look after the children. If you take the money out and you don't use it for childcare, then the 20% contribution is clawed back again, which is fair enough. People who are currently receiving the childcare vouchers can make a choice between the tax-free childcare and the childcare vouchers. Now, the limits for the tax-free childcare, it's per child, and it's up to £10,000. So you would either get 20% of the costs if it was under £10,000, or the full £2,000 of relief for each child. So it's quite generous. And those who are provided with workplace nurseries aren't affected by this, and you can actually have both, which is very generous. I very rarely talk about national insurance simply because it's so boring. And the only change that ever happens is usually the rate changes. But with effect from April, there's going to be an employment allowance for employers who can reclaim the first £2,000 of their national insurance contributions, which is going to be extremely helpful for small employers. Where you've got multiple payrolls, so perhaps you've got a group of companies, you can actually elect which company will claim the allowance. But some employers are excluded, so people running domestic payrolls, you know, your chauffeur, your gardener, your nanny, your cook, so on, you don't get it for that. Obviously public authorities, but also people who are doing work for the public sector, so GP practices, NHS dentists, anyone who has a substantial amount of work carried out for local councils and things, they won't qualify. And anybody with a personal service company where they're not taking salary from the company, they're only taking dividends. If there's a deemed payment calculation of salary, they don't get the relief. And continuing with national insurance, from April 2015, there's going to be an exemption for anyone employing under 21s. John mentioned how important it is for young people to get into work. There is an upper limit, so football clubs are not going to be able to claim this relief. It would be outrageous if a 20-year-old earning £200,000 a week, their employer had the NIC exemption. So it's going to be the upper earnings limit, but I don't think there'll be many under 21s earning more than that. And we don't have any details of this, but there's going to be a new voluntary contribution. So someone who's not going to get a full state pension, there's only certain circumstances where they can make voluntary contributions. And you can't make them once you reach retirement age. So this new Class 3 is going to be available to top up your state pension entitlement. We don't have any other details about it yet. It doesn't start until October 15. And finally, on national insurance, a really sensible measure. Class 2 national insurance, anyone who's self-employed has to pay a weekly Class 2 stamp of, it's about £2.65 a week, and they also pay Class 4 on their profits. Well, it must cost more to collect Class 2 than it actually does collect, so they're going to merge that with Class 4, which is a really sensible idea, but that's not going to take place until 2016. There's been a lot of talk recently about merging tax and national insurance, but to be honest, I think it's just going to be too difficult to do, and that seems to have dropped off the agenda for the time being. John mentioned incentives for businesses to invest. The annual investment allowance, if you recall, last year it was increased for capital expenditure on items of plant and machinery and that sort of thing. From £25,000, there was a temporary increase to £250,000 through till January 2014. Well, a very welcome increase to this has been announced with effect from the 1st of April this year. It's going to increase temporarily to the first £500,000 of expenditure on plant and machinery or integral features, and that'll go through to the 31st of December 2015. When we think it's going to revert back to £25,000 a year, but who knows, it might be extended. Obviously, if you've got an accounting period that spans the change, there's going to be an adjustment, and a company with an accounting period of 31st December will be able to claim a maximum of £437,500, of which no more must be in respect of actual expenditure of £250,000 falling before the 1st of April. It'll be really frustrating if you've just bought a piece of plant that was, say, £300,000, that you're not going to get the full relief on it. But it's inevitable when they're changing the amounts all the time that somebody always loses out. And finally, I want to look at something that will be of interest to any of you who have let property, and it's a residential let as opposed to a commercial let. This is sort of sneaked in under the radar. The Inland Revenue are of the view that it won't make any difference to people, but I think it will. Where you let a property, a residential property, you're not entitled to any capital allowances for things like the white goods, the furniture, that sort of thing. But if you let a furnished property, you're allowed to claim a 10% wear and tear allowance or a renewals allowance for furnishings and things. And where repairs are made to fixtures such as replacement kitchens, then you're able to claim relief for the repairs. But the renewals basis has been withdrawn from the 6th of April 2013 by a change in the legislation. So anybody with an unfurnished or partly furnished property will no longer be able to claim replacement relief for things like carpets and white goods and curtains, because quite often unfurnished property will have those sort of things in them, but no furniture. HMRC have insisted that it's not going to make any difference to anybody. Well, if it isn't, why have they introduced it? And there is actually a debate within the profession about what the legislation actually means, because it's not very clear, and the Revenue have been asked to provide some clarity on this, because it is unfair and it does discriminate against landlords of unfurnished residential properties. That's my closing topic, property income, and Nadim's going to pick up some property themes now in his talk. Thank you.